few more posers. When to use Rule 11 UA1CB for determination of fair market value of unquoted share. In simple words, only in case of a profit-making company which is having positive net worth, use of 11 UA1CB is possible. Can a loss-making company be valued based on Rule 11 UA1CB for determination of fair market value of unquoted share? Yes, even a loss-making company can be valued based on Rule 11 UA1CB so long as the amount of loss this company has incurred so far has not completely eroded its net worth. So long as the net worth is positive, that means company is making losses, but the net worth is not fully eroded. In that case also, Rule 11 UA1CB can be used for the purpose of valuation. Number 3. How to do valuation of a loss-making company having negative net worth for determination of fair market value of its unquoted shares. So remember, there is a company whose net worth is fully eroded. Can this company still be used using the Rule 11 UA1CB? Yes, it can still be valued using Rule 11 UA1CB even though the net worth is completely eroded. How will that happen? That will happen when you do the valuation of the jewelry, in case this company is having any. If you do the valuation of the shares of unquoted company which this company is having, and if you do the valuation of the immovable assets, if the excess of valuation of these three categories of the assets exceeds the amount of negative net worth this company is having, in that case also Rule 11 UA1CB can be used. How to do valuation of unquoted shares of a loss-making company having negative net worth and no potential to turn around? So remember, please remember, it's a myth. It's a myth that you have to use only Rule 11 UA1CB. You cannot use the discounted cash flow method. It is not so at all. As a matter of fact, when you use the discounted cash flow method, you will be arriving at a higher capital gain, if at all there is any, and that would make happy the income tax department. So therefore, it is not that as per Rule 11 UA1CB only NAV is to be used. You can always use the discounted cash flow method, because discounted cash flow method will always give a higher value and the department will always be happy. The department will always be happy. So so long as the company has the potential to turn around, you can do the valuation using the discounted cash flow method. If the company does not have the potential of turning around, then using the discounted cash flow method is of no meaning, because companies are not going to turn around only, and the discounted cash flow method will not work as well. So that is what it is. And in any case, friends, please remember, if a company does not have the potential to turn around, what is the use of doing the valuation of that company? In any case, dispose it out, dispose of the assets and close that company. What are the consequences of Rule 11 UA1CB based valuation of unquoted shares? So what are the consequences of Rule 11 UA1CB based valuation of unquoted shares? So when you do the valuation of a company using the Rule 11 UA1CB, you arrive at a minimum price that company should fetch in any case, and that is the consequence of Rule 11 UA1CB. Why has the department not included discounted cash flow for Rule 11 UA2? DCF method would give more value, so more capital gain, thereby more capital gain tax for the department. So please remember, as I said earlier, there is no prohibition, there is no restriction that you cannot use the discounted cash flow method. You can always use the discounted cash flow method. The department wants to ensure that you do the valuation which is at least minimum. You do not do the valuation which is even below the minimum. So when you do the NAV valuation is the minimum that you should fetch in any case. So that is why the department speaks about Rule 11 UA 1CB. It does not nowhere says that a company cannot do its valuation based on the discounted cash flow method. Please remember, when you do the valuation based on the discounted cash flow method, you will arrive at a higher fair market value. That will mean more revenue to the department, and department will always be happy. The only question that can arise is whether the only question that can arise is will who should do the valuation for based on the discounted cash flow. Now in my understanding, that's a question which we of course need to discuss separately. Any question from anyone?